Welcome back, everybody. Today we're going to be checking out some bearishness forecasted for August and September by Hightower's Stephanie Link, as well as some folks on CNBC. So they're going to be giving their opinions and telling why the market should go down. It's kind of overpriced, and I'll give my opinion also. Make sure to hit that like button. Let's get on into it, guys.
Now is Stephanie Link, Hightower Chief Investment Strategist and a CNBC contributor. Steph, good morning. Good morning. It seems like, as we all know, the market kind of entered August kind of hot. We were maybe a little bit stretched technically, and I think that, interestingly, too, the response to earnings reports, even though earnings have been, on balance, quite good relative to expectations, it's been a little bit of a ungenerous response by the market. So what does that tell you in terms of what the market's already essentially priced in here?
And good morning. Seriously, we've had like a really great run year to date, up about 17% in the S&P 500. And you know, Mike, the long-term total return average for the S&P 500 is about 7%. So we are definitely.
So it looks like we definitely still have the Dow lagging by quite a bit, not even nearing the 15% year yet. Then we have S&P right at about 15% with this pullback. And then, of course, the NASDAQ with all the tech stocks is going to be up about 30–35%.
Having a good year definitely makes up for last year for sure. But I think we're probably going to see a kind of a choppiness, if you will, in August and maybe even into September. But I'm encouraged that earnings are hanging in and that we are seeing a broadening out in the market. And I think there's opportunities to be had as a result.
And in terms of the yield move that has obviously gotten the market's attention, gotten investors' attention above 4%, you know.
And right before they change this chart here, you can see that this trajectory is a lot steeper than these last few months. We have been kind of broadening out, which is healthy. You'd rather see kind of a broadening out but still going up rather than just a sharp up and sharp down, in my opinion. Kind of like back here. We've learned from back here the staircase pattern, and now we're starting to broaden out. Hopefully we can just go sideways until we get the next leg.
You know, there's no magic level that means one thing or another for where the stock market can trade, but above 4% has tended to be a stop and wait and back off level for the market. So can this be absorbed?
Well, yes, certainly. And again, that's going to be part of the chop that we see this month, maybe next month, maybe until the end of the year, Mike, right? So because we've had a really nice results so far this year. I think overall, I just continue to watch the macroeconomic data, and that continues to be better than expected. The job market continues to be very healthy, whether you look at ADP, initial claims, JOLTS, even the non-farm payroll number on Friday was perfectly fine. It's very healthy. Wages are actually on the rise at 4.4%. Consumer continues to hang in there. It's not all perfect, of course, but I do think that there are opportunities, as I mentioned. I think the most important, by the way, the most important data point from last
the average hourly earnings, I guess, for the year 2023. The average not where I am. 27 on the low end, 27.60 all the way up to now. The average is $29 an hour. Yeah, alrighty, folks.
Last week was the productivity number coming in way better than expected.
Maybe around 20 to 25, which is still good, up from 10 to 20 or 10 to 15.
As well as the unit labor cost number coming in lower than expected. That directly feeds into GDP. And, we've seen an acceleration in GDP year to date. I think all that is really healthy. That's good. So if we do chop around, as I mentioned, there are opportunities out there when stocks pull back and you see the volatility increase. I think you have to look for bottoms-up fundamental stories that are on sale.
Yeah, I mean, certainly the productivity growth has been a missing piece of the story, and it would be great if it continues. Those numbers do bounce around, but absolutely it's been a help most recently.
We finally got a tick up on the VIX. The VIX just seemed like it was just just puttering out of nowhere. Apparently all the fear was just getting lost day by day by day by day. But now we've kind of got a bottom, which it's bittersweet. We've got some fear, which means we can get some bigger moves down to the downside, which is not always the best.
What types of stories make sense here? We did see, Apple, which had been just kind of going up in this very, very orderly upside angle. It seems to have broken a little bit. So I just wonder if that means there's
a little bit. Look at this perfect channel. I mean, and if you look at it today with today's move, this is after the market's open been a little bit. It's farther down. So I mean, and it's straight red. Almost every 4-hour candle is red. So it's a dramatic break. It's not a maybe.
a change of character in this market and where it looks like things might be able to firm up.
Yeah, no, and so to that point, yeah, I mean, Apple's had a nice run year to date. The FANG stocks, technology, growth, all have had really nice moves. I think you want to look elsewhere. I think you want to look at some of the other parts of the market that are starting to perk up, Mike, right? So we are seeing the broadening out energy, industrials, materials, some financials for sure. I think Apple takes a breather. I think that quarter was fine, right? I mean, we didn't like the iPhone numbers or iPad numbers, but services was quite good. And that's now 25% of total revenues. But it trading at 33 times, it was priced for perfection, and you didn't get perfection. You had an inline quarter. So nothing wrong with it, but I think it might pause for a while. On the flip side, we saw something like Fortinet on Friday, cybersecurity, get crushed at down 25%. That's the kind of opportunity I'm looking for. I own it, so to be fair, it was a little bit of a bruising on Friday for me, but I do not think the long-term algo is changed of mid-teens growth, 100 to 200 basis.
Okay, I don't know what she's doing messing around with Fortinet. I don't know, going from 80 to 50 in just a couple of days. All right, she just needs to focus back on Apple here.
Points of margin expansion per year, 20% free cash flow growth. So again, like it's down 25%. What do you want to do? You want to take advantage of some of those kinds of names. That being said, if we do see a broadening in the market, technology may lag, and these other sectors might do better, and they're cheaper for sure.
So what are my opinions on the choppiness for August and September? I think maybe we'll have a choppy sideways session. I don't think it honestly will be too choppy. Let me retract the word. I think we'll have a sideways session at best. With Apple as down as much as it already is. I mean, we've had a 5% day, and now today it's already down 2.5%. So, and on a $3.5 trillion market cap, guys, that's money moving. So that's already bringing in a lot of the downside move. I would have to think it's going to start bottoming in the next few days, just based on how healthy it's been. It can't really keep going too much farther without too much interest coming in. And if it does, then we might get the pullback everybody's been asking for and waiting for. Do I think that's going to happen? No, I don't think that's going to happen. At best, we'll go sideways, and everybody that missed out will be hoping this is the time that they can get in at the bottoms, and it'll be another time that they missed out just for the markets to shoot higher, and just they'll have to get in at higher prices, higher and higher and higher, and that'll be the money that brings us up. Anyway, that brings us to the end of this video. Make sure you hit the like button, subscribe. We're going to be doing this every single day, guys, and I'll catch you in the next one. Peace.